Welcome to the Balance Sheet Solutions ALM Board Training Series. Session 3, Net Economic Value. This session will discuss the ALM metric of net economic value and why it is so important to evaluate the risk of your credit union. We will also examine common risk-return trade-offs that a credit union faces and look at how your modeling assumptions influence the calculation of the net economic value. How do you measure the value of your credit union? Is it by asset size or maybe by the number of branches? Or do you measure the credit union by intangibles, such as name recognition or community service? From the NCUA perspective, the value of your credit union is determined by your net economic value, which is the market value of your assets minus the market value of your liabilities at a given point in time. The market value of your credit union at any one time is determined by the assets and liabilities on your balance sheet and how they relate to the current market environment. The ALM reports will create a net economic value simulation which will forecast the present value of these assets and liabilities in different rate scenarios. For example, if your balance sheet is made up of low-yielding fixed loans and investments, the net economic value of your assets is probably projected to decline in higher rate environments. As we learned from previous sessions, if these assets are long-term, the net economic value decline will be amplified in higher rate environments. Net economic value will also evaluate embedded options within each asset, such as prepayment risk, and assess how that will impact the value of the asset in various rate environments. Why is the net economic value figure so important to examiners? Remember that the NCUA is responsible for the share insurance fund. They need to monitor if a credit union is highly exposed to a change in market value if rates move. Since net economic value will evaluate all future cash flows of every asset and liability, it is a thorough picture of the long-term interest rate risk of the credit union, not just a 12-month projection like net interest income. The ALM reports will help both the credit union and examiner see if the current position of the balance sheet would cause problems in different rate environments. In this example, a 33% decline would be experienced by the credit union from their base case net economic value if interest rates were to increase by 300 basis points. This is a significant shift, and if such a rate move were probable, the credit union may be encouraged to reduce the amount of risk on the balance sheet. In previous sessions, we have talked extensively about the balance that a credit union must face between income and risk. Longer-term assets can provide higher levels of income for the credit union, but pose more risk, especially when rates move. This graphic shows the market value change for a 1-year, 3-year, and 5-year agency bond for a given change in interest rates. If a credit union is heavily weighted towards longer-term investments, this decline in market value will be reflected in the net economic value calculation. To assess the different types of risk on the balance sheet, let's compare two popular loan categories: mortgages and auto loans. A longer asset, such as a 15 or 30-year mortgage, will experience more price instability for a given move in interest rates than a shorter asset, such as a 5-year auto loan. So, if a credit union's balance sheet is heavy with long-term mortgages, this will be reflected in the net economic value fluctuations in the ALM report. In this example, the credit union has a similar balance in both their mortgage and auto loan portfolios. Starting with the flat environment, they would see a decline in the market value of both portfolios if interest rates were to rise. However, the mortgage portfolio would see a decline of 7.72% in the plus 300 environment, while the auto loans would only see a 3.42% decline. The long-term nature of the mortgage poses more risk to the market value as compared to the autos. These are just two loan categories of many on a credit union's balance sheet that provide a great example of the impact of longer-term assets on net economic value. Longer-term investments, such as long-dated agency bonds or mortgage-backed securities, also carry the same risk and will significantly impact the net economic value calculations. So again, we are at the common decision that many credit unions have to face. Less risk with a shorter-term asset that provides lower income, or take on more risk with a longer-term asset that can provide a higher cash flow. Each credit union is different and needs to arrive at their own balance of short-term and long-term assets. Different risk tolerances, membership demands, and income goals will lead each credit union to arrive at the balance that works best for them. Let's return to the example of our two credit unions. Credit Union A has focused on longer-term assets to bring in higher income levels in the current environment. As their ALM reports show, their net economic value faces a 29% decline in the plus 300 environment. While this does not violate policy metrics, it may cause some concern among management, and steps may want to be taken to reduce this risk. Credit Union B, on the other hand, chose to keep their assets short to avoid high levels of interest rate risk. As a result, their income levels have remained low, but they are only seeing a net economic value decline of 6.65% in the plus 300 environment. This probably would cause no concern among management. We continue to stress that every credit union is unique and risk tolerance levels are no exception. NCUA does not have implicit standards for net economic value fluctuation, but their guidance recommends that no credit union experience a decline of greater than 50% from the base scenario. If a credit union's ALM reports show that they are heading towards this limitation, they may want to make changes to their balance sheet to lessen this interest rate risk before thresholds are exceeded. If a credit union does exceed the 50% target, examiners may ask for a plan to reduce this interest rate risk exposure. Your net economic value calculation also reflects the market value of your credit union's capital. The net economic value capital ratio is simply the net economic value divided by total assets. So, the net economic value capital ratio will move in sync with your net economic value movements. For Credit Union A, the large decline in net economic value will result in a similar movement in their net economic value capital ratio. The fall from 12.66% to 9.56% is significant, and the credit union will want to closely monitor this situation. For Credit Union B, the decline in net economic value has only led to a 0.07% decline in their net economic value capital ratio, and they remain well above 12% in the plus 300 environment. So what happens when a credit union needs to make changes to avoid future net economic value risk? In most cases, the credit union will need to assess getting rid of some of their riskier assets. If this is not possible, they will have to reevaluate the newer assets that come on the balance sheet and focus on those that do not add much interest rate risk, such as floating rate assets or shorter term loans and investment. Like anything in ALM, the net economic value is strongly driven by the assumptions that are built into the model. Ideally, assumptions that most closely resemble both the behavior of your assets and membership will create the best results. So, it is important that assumptions are reviewed on a regular basis and that the impact of these assumptions be understood by credit union management. One modeling assumption that can have a significant impact on the modeling results is the prepayment speeds used in the model. These speeds reflect the projected amount of excess principal made in addition to scheduled principal on loans and mortgage-backed securities. In many models, national averages are provided for the various loan types. But if your members behave differently, this may cause the model to make incorrect projections, which may over or understate your cash flows. For example, if your members tend to pay faster than the national average, the model will understate your projected cash flows. You will be reinvesting at a faster pace than the model, and it may reflect a longer average life than what you actually hold on the asset. All of this can result in an incorrect valuation on the asset. The liability side also has many assumptions built into the model, which can have a major impact on the net economic value calculation. Since non-maturity liabilities represent a major source of funding for a credit union, many ALM models provide a discount on these shares as they represent a benefit to the credit union. By lessening this liability, equity will be increased, which will help to boost the credit union's net economic value capital ratio. However, in 2016, the NCUA became concerned that credit unions were taking too much of a discount on these liabilities and therefore overstating their equity. So, in 2017, the NCUA mandated that credit unions implement a supervisory test that set a standard discount on all maturity liabilities. The idea behind this test is to see how every credit union is projected to perform when using a standard set of assumptions. The examiner will look at how the credit union is projected to perform in the flat and plus 300 environment with these standardized assumptions. Should the post-shock net economic value ratio and the net economic value sensitivity fall within risky limits, the credit union may face a higher level of examination. At a post-shock net economic value ratio of 7.22% and net economic value sensitivity of negative 25.70%, this credit union would remain in the low risk category. Those credit unions that fall into the high and extreme risk categories will face more scrutiny on their next exam. As you can see, net economic value is a comprehensive and important calculation for both management and examiners to assess the interest rate risk exposure of a credit union. Both management and the board of directors should have an understanding of what this ratio represents and how it can be impacted by a change in rates and modeling assumptions. For our next and final session, we will review the ALM concepts and show how ALM can be used as a useful tool at your credit union.